Welcome to the Wealth Exchange, your access to the experts addressing the issues affluent families across Canada face every day, from market commentary and planning strategies to leadership and philanthropy. We discuss the subjects that matter to you.
At Nicola Wealth, we specialize in holistic wealth and asset management for accomplished individuals, multi-generational families, institutions, and foundations. In each episode, we aim to provide access to expert insights on a variety of planning topics, market commentary, general education on investing strategies, and on Nicola Wealth's unique approach to building and preserving wealth.
I'm Jasmine Marichic, Wealth Advisor at Nicola Wealth and host of the Nicola Wealth Quarterly Commentary. In these episodes, we connect with our in-house portfolio managers to get their take on the past quarter's economic events and provide a macro outlook as we advance through the year. Today, I had the opportunity to speak with Ben Jang, portfolio manager at Nicola Wealth. Ben gave us a quick history lesson to help with recency bias, with a goal to help put recent returns in perspective and help investors better understand what are reasonable long-term return expectations. He touched on inflation, direction of interest rates, and gap between the performance between US and Canada. Lastly, I liked Ben's advice for anyone holding cash-like investments. Ben wrapped up with a story I love about the gold rush in 1896 that drove a great lesson home. I hope you enjoyed the discussion and find it helpful. Ben, welcome to the show.
Thanks, Jasmine. Thanks for having me again.
To jump right into it, markets have had a great run last year and year to date. What are some of the themes that you're seeing, and do you still see opportunity?
Yeah, so the bull market that we saw from last year has continued on in the first quarter of this year, and so it's been beneficial for risk-on assets. What's interesting is that rally has broadened out. So the largest contributor by a big margin last year was the Magnificent Seven. But since then, technology stocks have continued to do well in general, but we've seen other sectors start to participate and support that rally. And so that's a large theme that's happening in the markets today. Also, we're continuing to see supply chain bottlenecks, which have been supportive of higher commodity prices, which have threatened to push inflation even higher. And because of that, we've seen a change in sentiment in terms of the rate environment. Whereas at the start of this year, a lot of traders were expecting us to have 6 or 7 rate cuts. Now we're discounting less than 3, so 2 to 3. So those are the large dynamics at play that we're seeing in the markets today.
That's a great broad update. One of the things that we talk to clients a lot about is people have a hard time with recency bias, which has investors believe in recent events over historic ones. Can you walk us through the history of US markets, not just in the last decade, but multi-decades, to give listeners some perspective?
Yeah, so if we take a look recently, so I'll start with that. The start of this decade, we've had quite strong returns. The prior decade, we've had very strong returns as well, really since the great financial crisis. So the corrections that we've had since then have been relatively shallow, or the recovery has been extremely sharp. But if we take a look at history over the long term in the US marketplace, going back 150 years or so, the total return in the market is about 9%, but the real total return, so the inflation-adjusted returns, about 7%. Within that, though, and this is what a lot of people miss, is that there have been long periods of time within the marketplace where we've had flat returns. And so it hasn't been as drastic as Japan, where we saw basically 30 years for the Japanese stock market to hit a new high. But historically, we've had lost decades. More recently, in the 2000s, we've had a decade where we've had negative returns in both nominal terms and real terms. And this is something that we've seen a few other times historically as well. We saw that in the 1970s, where real returns were negative. We saw that in the 1910s and other periods within history where we've had really low returns on a real return basis for that full decade.
Great history lesson. It is important to think back because that lost period of flat returns that you speak of, it was really hard to digest for investors during that time. Ben, can you give us an update on inflation in Canada and US and tied in your thoughts of possibility of interest rate cutting in Canada this year?
Yeah, so we've seen an interesting dynamic that start to develop this year, and that is there's a growing gap in economic performance between the US and Canada, and also somewhat on the margin in terms of inflation. In the US, we've seen persistently strong macro and inflationary data, which will make it more difficult for the Fed to start rate cuts. So we're not saying that they won't, but the timing of which has potentially been pushed back, and the aggressiveness of cuts will likely be pushed back. When we take a look and compare that to Canada, so yes, gas prices have caused inflation to remain slightly elevated, but overall, we've seen a shift in the trend of downward momentum for core inflation in Canada. When we take a look at the GDP numbers, we did see a surge in January, but a lot of that's contributed to one-off effects. So there was a public sector strike in Quebec that likely contributed to that. And also on the margin, we're seeing some weakening economic activity as it pertains to business insolvencies, and also on the margin in terms of unemployment. So net, when we take a look, we think that there's going to be some divergence between Canada and the US, and Canada will likely start to cut rates earlier and maybe a little bit more aggressively than our neighbors down south.
With the conversation of inflation, and interest rates, we've seen this rise of interest rates, which has resulted in cash-like investments paying anywhere from 4 to 5%. And so I want to ask, what advice would you give to individuals that are looking to choose between investing in cash-like securities versus bonds?
So with elevated rates, cash investments are relatively attractive. That being said, on the margin, some of that has changed. At the end of January, there were regulatory changes in terms of HISAs, or high interest savings accounts, which have migrated returns from HISAs from about 5.5% down to just below 5%. So on the margin, it's a little bit less attractive, but overall, it's still relatively attractive. That being said, with Canada likely to cut interest rates, those yields are not set. And so although we like cash, we like it as a tool that is being utilized for tactical opportunities, but strategically, we prefer bonds, which would benefit from rate cuts, and we think over the long term has a better return proposition.
Ben, as you mentioned, interest rate expectations have changed. The market went from pricing 6 rate cuts, like you mentioned, to now 3 rate cuts this year, and who knows how it all play out. If interest rates stay higher for longer and companies need to operate in a higher interest rate environment, how is this going to affect the companies in equity portfolios?
I think at these levels, these relatively restrictive levels, if they're kept this high for a prolonged period of time, net, it'll be negative for most companies. That being said, we don't anticipate the rates to be this high for a very long period of time. I think the answer to your question is a multifaceted approach. So when we think about rates and how it impacts companies, obviously it impacts borrowing costs. So companies that are more indebted, or it is more punitive for them. But at the same time, if we think about that environment, it generally coincides with a stronger economic environment. And so there would be a stronger economy to lift companies up. We also have to think about how it impacts the allocation. So again, when we think about cash or fixed income with higher rates, it makes fixed income more attractive. And so investors are likely to allocate more to fixed income versus equities. And finally, we have to think about valuations. So with higher interest rates, it impacts the discount rates used to value future cash flows. So it impacts valuations. So overall, there's not a straight answer, but I think at these levels, it's generally speaking a little bit too high for equity markets, and particularly since of the strength that we've seen in equity markets.
3 out of 6 largest economies are in a recession. So Germany, UK, and Japan. Is there indication North America might be next?
I think when you take a look at the margin in terms of the economic data, there's a higher likelihood of a soft landing playing out in the US. And I think most people believe that both Canada and US are likely to be able to avoid a recession. So a lot of economists have pegged GDP this year in Canada to be muted, but still positive. A lot of that is influenced by inflation and rates that we've talked about. So it's dependent on the central bank reaction. But that being said, most of the market is constructive that North America will be able to avoid a recession. And even if we do hit one, it won't be a prolonged recession.
Well, that's definitely great to hear. That would be good. 2024, I just want to shift. 2024 is the single biggest election year in history with over 50 global elections this year. We have mentioned that before. How do you expect this to impact the investment market landscape?
When I think about elections and their impact on markets, there's two aspects. There's a direct relationship and there's an indirect relationship. The direct relationship is the specific industries that would benefit from a certain party's platform. For example, depending who's in power, it could mean that there's an increase in defense spending or healthcare spending. So that would be a benefit to certain industries and companies. The indirect, when we think about elections, is there's a human element where, generally speaking, people are more focused on the short term versus the long term, short term gratification versus long term. And if there's an election that's relatively tight, the incumbent has certain tools at their disposal they're likely to utilize. And that likely means spending more money to appease voters. So when we have that many elections and the ability for incumbents to spend a bit more money, that is supportive of higher inflation. So that's a dynamic that we're looking at in general because of all of these elections.
Inflation sure keeps popping up in all the conversations. Ben, I want to wrap up with one last question. At this year's Nicola Wealth Strategic Outlook event that we had in the first quarter, you told a story I loved about the gold rush in the 1896, which explained well why it is smart to be wary of, next hot trends and to not chase returns. Could you give a quick summary of that story to listeners and explain what point you were hoping to drive home?
Yeah, for sure. So the Klondike Gold Rush was a fantastic opportunity. There was a lot of gold to be discovered. The problem was that there were too many people chasing that opportunity. And the people that became very wealthy because of the gold rush were really the first to move out there to the Yukon. So those prospectors found the best locations, and the people that followed them didn't do nearly as well. And most of them didn't find any gold or became wealthy at all. And there's a parallel to today's investing in terms of the themes that we're seeing. And that is a lot of these themes potentially are very, very good and interesting, and they're supportive of the general crowd, but they might not be also great investment opportunities, partially because they've become too crowded. The valuations are too expensive. So the analogy that we used was sometimes a picks and shovels approach is a bit better. And that is, look, being a direct investor or prospector for the gold rush, there's too many people chasing that opportunity, but there's still a lot of people that require picks and shovels to search for gold. Similarly, it was a great opportunity for Levi jeans, where everyone needed a very durable pair of pants. When we take a look at today's environment, when we think about that, we think, okay, there's a lot of themes that we're seeing out there, whether it be with aging demographics or whether it be with renewable energy. Some of those select plays in those themes are getting a bit expensive. And so we look at not just playing directly into those themes, but also looking at the picks and shovels approach or derivative plays, which would benefit from those themes, but at cheaper valuations.
I do love that story. Ben, thanks for your helpful insights today.
Thanks, Jasmine.
Thank you for listening to another episode of The Wealth Exchange. You can view today's show notes and subscribe to the podcast on our website at nicolawealth.com/The Wealth Exchange. Some of the companies or securities mentioned during this episode may be held at the time of recording by Nicola Wealth. Please view the show notes for full disclosure of our position in these companies. This podcast contains the current opinions of the presenter, and such opinions are subject to change without notice. This material is distributed for informational purposes only and is not intended to provide legal, accounting, tax, or specific investment advice. Please speak to your Nicola Wealth advisor for advice based on your unique circumstances. Forecasts, estimates, and certain information contained herein are based upon proprietary research and should not be considered as investment advice or a recommendation of any particular security, strategy, or investment product. Nicola Wealth funds and limited partnership returns are net of fund expenses charged to date. Any discussion of past performance is not indicative of future results. All investments contain risk and may gain or lose value. Projected returns are estimates only. Returns are not guaranteed. This is not a sales solicitation. This investment is intended for tax residents of Canada who are accredited investors. Residency restrictions apply. Please read the relevant documentation for additional details and important disclosure information, including terms of redemption and limited liquidity. Nicola Wealth Management Limited, Nicola Wealth, is registered as a portfolio manager, exempt market dealer, and investment fund manager with the required securities commissions.